So, hello everyone, and welcome back to another interesting company today with Hamborner REIT. It's real estate time today. I have CEO Niklas Karoff with us. He will run us through the presentation and give us insights into the current stage of the German real estate market and how Hamborner is performing so far. As usual, some housekeeping points. The presentation will last about 15 to 20 minutes. We will have time for Q&As about approximately 10 minutes. The presentation will be recorded, and if you have questions, you can put them down into the chat box on the bottom right. But given the time is precious, I'd like to hand over the microphone to you, Niklas. The floor is yours.
Yeah, thank you very much, and thanks for having the opportunity to introduce our company today. My name is Niklas Karoff. I'm the CEO of the company since 2020, and happy to introduce you and provide you with more details on what we do. Hamborner REIT is a German-based commercial real estate company. You can see a quick overview here on this page. The company has been founded many years ago, so it has a long track record, founded in the 50s, and also with a long track record concerning capital market presence. It has been then transformed many years ago into a REIT structure and is purely focused on, as I said, commercial real estate in Germany, with a portfolio of which I provide you with more insight in the next couple of minutes. We are a rather defensive player, being active in two asset classes, in retail and office. On the retail side, with a focus on food retail. Some portfolio data here on the left-hand side. Currently, portfolio size, latest portfolio size, were roughly 1.4 billion euros. And also on the right-hand side, you can see some key financials as of the end of September of this year. Hamborner, we have a fully integrated or widely integrated structure, meaning we are covering portfolio management, asset management, and property management tasks, as well as other functions like legal as well. And then we have outsourced our facility management. We are active, you can see it here on the right-hand side, concerning our geographical focus in various areas within Germany. However, we have a focus on so-called metropolitan regions, which you can see here with a more gray background. Spread across parts of Germany, but with some focused areas. You can see on the left-hand side, portfolio key metrics. The company has a pretty high occupancy rate, latest number 96.6%. And we are combining currently, or we are managing 64 properties. All of these properties are on our balance sheet, so we are no service provider for third parties. We own all the properties. The exposure you can see as well. So currently slightly more on the retail side, with 57% versus 43% on office properties. And the average remaining lease term across the portfolio is, as we think, an attractive number of 5.5 years. On the next two pages, I'd like to introduce you to a couple of properties from our portfolio. So what you can see are the largest properties in the portfolio. We have a presence here in various large German cities as well, as you can see over here, for instance, Berlin and Munich and Cologne. We think overall we have a stable portfolio with a overall very good quality, on these assets. I get back a little bit more on the tenant structure, which obviously is of large interest and importance for us. If you look at the properties, you can see they have a rather larger size. Typically our sweet spot for investments starts on the retail side at around 10 million euros and on the office side around 20 million euros. For historic reasons, we still have some smaller properties. However, in recent years, we have further concentrated this portfolio with the result of increasing the average size per asset and at the same time reducing the average age. So overall, we think we also have a pretty young portfolio here. Another snapshot on 5 additional assets. Here you see more on the retail side. If we talk about retail with Hamborner, we mainly talk about food retail, either as standalone food retail assets or integrated into retail parks / neighborhood shopping structures, where the food anchor typically has a pretty dominant or very important, at least a very important role within the structure of a multi-tenant property. Yeah, as I pointed out, tenant base is of high importance for us. On the left-hand side, you can see our top tenants as of end of September. I guess various names here will be familiar to you, maybe especially from the food retail side. So you can see some of the leading food retailers here in Germany, some of them being also active outside of Germany on an international basis. Roughly 1/3 of our entire rental income comes from food, in combination with DIY stores. So we think that this is a very good backbone within the portfolio. We like the food retail business for various reasons. It has shown relatively high stability over many years with highly professional market players here. And we think we really have a thorough understanding for this kind of business. And it's something which we also get overall a pretty good feedback from investors. On the office side, you can see our office portfolio. We have some very well-known tenants here as well, stable tenants being insurance group or also on the public side. And altogether, roughly 50% of our total rents comes from the top 10 tenants in our portfolio. A little bit more on the strategy. So we are following generally a 2-pillar strategy, as I pointed out, covering the asset class of retail and office. And we are the DNA of the company is rather conservative. So the major part of our portfolio consists of so-called core properties, which are defined by low vacancy, rather long average remaining lease terms, and no major refurbishment need or repositioning needs. On top of this, a couple of years ago, we decided to add or to adjust our strategy slightly by adding on a single asset base here certain properties to the portfolio with a larger value potential. And that's how we call it here, managed to core properties. These properties typically can have, for instance, larger vacancy, refurbishment or repositioning needs, or maybe have also the potential for additional letting space as part of some development measures. And we put them on top. But the DNA, as I said, of the company generally is rather conservative. With that, let's look on the On the financial structure of the company is on the financing side currently fully bank financed. We used to work in the past as well with another instrument, however, with a bonded loan. However, we decided to pay back this loan, and we are currently fully bank financed here. This divides into various banks. Some of them we have a very longer term relations already. And what you can see over here is the expiration schedule for our current financial liabilities for the upcoming years. So as we can see here, no major clustering risk on the financing side. And also on the right-hand side, if you look at the financial KPIs, we are pretty happy with those. Latest LTV 43.3%, with a net debt to EBITDA of 10.2 times, and also an EBITDA interest coverage ratio of 5.1. The average cost of debt currently have been 2.0%. However, considering the actual interest environment, this is going to increase in the upcoming years. And what you also see on this overview are the average costs of the financial liabilities here for each year, so to provide more transparency to our shareholders. Some key figures here as of end of September 2025. Funds from operations for the first 9 months coming in were 45 cents. This was lower than for the same period a year ago. Major reason for this has been the effect of some property sales within the end of 2024 and beginning of 2025. So the effect from this. You can see the REIT equity ratio with 55.8%, which leaves sufficient headroom to the minimum equity ratio that we have to provide based on the German REIT regime. And an EPRA net asset value, latest number here, 9.65 as of end of September. Few more words on the outlook for this year. We recently published our Q3 number, which I just stated from in the last couple of minutes. We slightly had changed or revised our full year guidance here to 89.5 to 90.5 million. So this within this range, that's where we think we're going to end up the end of the year. And we confirmed our full year guidance for the FFO of 44 to 46 million euros. And the main influencing factors you can see on the right hand side. We are expecting higher maintenance costs during the course of this year, and obviously also in effect had been the effect of the property disposals, as I just mentioned, as part of my explanation for the Q3 numbers. And last but not least, another word on the dividend strategy. Hamborner has a very long-term dividend strategy, history. So what you can see on the upper left-hand side here are the distributions for the last years. So our average payout ratio for the last 10 years, including 2024, which we distributed in 2025, had been 76% of our funds from operation. We decided beginning of the year here in the first half to revise to adjust our dividend strategy for instance, influenced also by the additional cost that we are facing here, and the overall situation. And we now, compared to before, we are now moving forward, working with a guide, with a range here that we anticipate of 60 to 70% of the FFO. Historically, we didn't provide any kind of fixed range, but we decided that to provide here more comfort and transparency for our shareholders, we're gonna looking forward to work with this range 60 to 70% of FFO, and that's the result of this adjustment. And the criteria for the final recommendation from our side to the shareholders for the annual meeting, you can see on the right-hand side, FFO remaining the key figure, but also income. We see other aspects as well if we look into our recommendation for the yearly dividend, and that's what you can see on the right-hand side. Yeah, so overall, in a nutshell, I think Hamborner represents a very well-established national commercial listed player here in Germany with a long-term historic background. I think we are very transparent in what we do. I think you find a lot of helpful information on the website, in our publications. We are very active also on the sustainability side. We have spent tremendous amount of effort and also have invested in recent years into this topic. We are on a good track here concerning our sustainability strategy. So overall, I think we are well positioned, and our aim is here clearly to grow this platform looking forward, depending obviously on the overall market situation, being it on the investment market as well as on the capital market side. Yeah, and with that, for now, thanks for your attention, and happy to answer your questions.
Thank you, Niklas, for your presentation. Interesting presentation, and we have quite a lot of questions already in the chat box. But before we dive into these questions, there's one question from my side. If I look at your numbers, especially your funds from operations, I think after 9 months, you achieved 36.7 million. If you do the math and try to extrapolate for the full year, you get to a number which is slightly higher than your guidance. What can we expect for the fourth quarter? Is your guidance conservative, or is there more cash outflow expected in the last quarter? So how should we see that?
Yeah, I think there are a couple of effects that should be considered. One is that if you do the math, in the first quarter, and there were still the effects from assets at this point in time, which contributed to our FFO, because the transaction were closed during the course of the first half of the, or during the first couple of months. So we still got some FFO participation, which we don't have now during the fourth quarter, so if you compare the numbers. And secondly, on top of this, especially if you look on the investment side, meaning maintenance expenditure, it's not unusual that during the second half of the year, you have a higher part of the maintenance expenses, and this also obviously then has an impact on the FFO, and that's why we confirmed our FFO guidance as we had it before, with a range of 44 to 46 million.
Okay, fair enough. Thank you very much. There are a couple of questions regarding the market environment. Maybe I can combine the two questions here. Given the challenging market environment, how do you intend to achieve your return targets through the new acquisitions versus securing or restructuring the existing portfolio?
Yeah, very good question. I think it's fair to say that the current market environment overall, meaning being on one hand the investment markets here for the real estate assets, as well as the capital market situation, doesn't leave us too much room to maneuver. I mean, we clearly try to continue on a very disciplined way. We see ourselves as active portfolio managers, meaning we are selecting every year certain assets that for operational or other reasons we want to sell. And then we try to find good market timing and try to balance this out with what we get on the acquisition side, concerning quality, concerning pricing, concerning risk return profile. And by that, apart from the potential that we have to grow on the letting side, then also to add additional value here and additional potential for further growth on the basis of individual sales and acquisitions of assets. Yeah, but I think, as I said, it's fair to say at the moment it's quite a narrow road based on what we have on the table. So we have to be disciplined here and look at each situation, each asset, in which case makes it sense to sell an asset now compared to what we get in return for this if we do the rotation with acquiring another asset.
Fair enough. Thank you very much. The next two questions, we probably need a crystal ball to answer these. It's regarding the interest rate. The one question states, with interest rates still elevated, how are you managing refinancing risks and funding costs? Do you see opportunities to lock in favorable long-term financing or deleverage selectively?
Yeah, maybe I jump quickly back to this financing sheet so that it's for everyone, that it's easier to reflect on this. Yeah, I'm also over here. It's a kind of balancing that we do as an active portfolio manager. If we go into refinancing activities for our assets, we always have to keep in mind what's the individual strategy for each asset which is up for financing. I mean, and therefore, compared to where Hamborner came from, we tend to be much more flexible here also concerning the financing, meaning the durations. Yeah, Hamborner comes from a history where typically only long-term financing, mostly only long-term financing was locked in, whereas now we also go into shorter terms, and depending on the strategy for each asset, then obviously, because if for example if we tap an asset for a potential sale 2 years from now, it makes for us no sense potentially to lock in a 7-year financing for this asset. So therefore, to balance this out and reflect on this on a yearly basis, that's part of our financing strategy, and it has to go hand in hand with the portfolio management.
Do you have any expectations where interest rates might head in the next couple of years? I mean, this might be in ideas for you to lock in longer periods or shorter periods, or as you mentioned, you keep it on an asset.
I mean, as of today, and I mean, we're talking about what's a long-term period, but let's say for the next 2-3 years, we don't see any major shifts on the financing side. Therefore, it doesn't have a currently, as of today, based on how I look on the financing future year or concerning financing rates, it doesn't have a major impact. It's more driven by other aspects, as the one I just mentioned. Yeah. And because otherwise, if you would expect major movements, this might be different, but that's not the case. Okay, perfect.
Let's move over to the topic of your dividend payments. You have this chart where you have seen this impressive dividend history. You have a very long history of offering a stable dividend, although you have just amended your strategy here. how are you balancing the objective of maintaining distributions with potential needs to reinvest or portfolio optimization?
Yeah. Very good question. I mean, obviously for us, we intend to distribute an attractive dividend to our shareholders. I mean, that's clearly the main goal, and if possible, then keeping some additional some additional profits for further investment into the portfolio. And also here, it's about balancing finally. Yeah. And that's one reason why we adjusted the dividend strategy here, because otherwise the room for maneuvering here for us and for flexibility would have been so limited that we said, okay, we rather adjust it here to be on a yearly basis in the position really to look at the individual situation of the company, what kind of investments are needed within the next 12 months, what is the market offering as opportunities, where do we position ourselves concerning our dividend return as well, with reference to how the past business year has been. And so therefore, that's how we look at it and try to get as much flexibility for the company. But having said this, again, to stress it, an attractive dividend player, that's something where Hamborner is very well known for, and that's what we clearly want to remain as well.
Thank you very much. I think the next two questions, again, we can also try to answer them in a combined answer. It's about tenant behavior and about sustainability. So how is sustainability and tenant demand for energy efficient buildings influence your asset management strategy, particularly for older rental or office properties?
Yeah, it has a significant impact on our strategy, operationally as well as from a strategic point of view. Operationally, give you an example, we see the impact of the sustainability topics with letting contracts. So we try to implement in each letting contract that we have a green clause part where tenant and landlord they jointly commit themselves on certain measures to support sustainable aspects. That's one thing. Secondly, it's about the whole investment strategy on the asset level. So if we do our maintenance and CapEx planning, the question is, how much do we really need to and want to invest for purposes which directly or indirectly support sustainability of the property? And to provide you here with more transparency, we even publish on a yearly basis, I think since last year, with a forecast of 3 years, how much we intend to spend for sustainability measures divided into different boxes on maintenance and as well as on CapEx. So you can see it as well in our presentation. So you can see on the operational side, this has a very strong impact on what we do and on a yearly basis. And therefore, on the strategic base, obviously, we talk about value preserving, preservation of values. I mean, that's clearly one thing. And I can show this figure here. Yeah, here you can see it. That's what I just said. So for our guests here in the presentation, so you can see our cost indication for property and building maintenance divided into maintenance and CapEx spending. You can see how much we spent in 2024 and for this year and for the upcoming 2 years. And we divide it. I said we make different boxes. So we divide into measures which are regular maintenance, which have no direct impact on sustainability. Then some measures it's a kind of mixture, and additional measures will be purely pay into this into the sustainability part. Yeah. And the main areas of focus you can see here on the right-hand side. So there's a numerous number of measures that we do here. And I was just pointing out on the strategic side, we also think that's of very strong importance, because if you look on the transaction market, the topic of sustainability on the sales and acquisition processes is becoming more and more important. So it's also a matter of how can we grow and further develop the quality of the portfolio, which has also a good balance and a good future perspective, part of the regulative aspects based on the legal framework that we have here in Germany. Yeah, so it's a combination of personal conviction plus the needs from the investment market, and that's what we clearly get as a feedback also from the investment market concerning the importance of this topic.
Perfect. Well, unfortunately, we're running out of time, but thank you very much for this very interesting presentation. To all other participants, you will find the link to the next presentation, Hello Fresh, on the bottom right. Niklas, thank you very much for participating. If you have a minute afterwards, I'm glad to have a quick chat. And all others, please have nice meetings going forward today. Thank you.
Thanks again.